July 2015. Across Greece, people wake up and check their bank accounts. The numbers are still there. Savings, salaries, retirement funds. Nothing appears to have changed. But when they try to withdraw their money, something strange happens. The banks are closed. Automated teller machines still work, but only partially. Withdrawals are limited to 60 euros per day. At first, people assume it is temporary, but by afternoon, the lines stretch down entire city blocks. Some machines run out of cash within hours. Others simply stop dispensing money altogether. Pensioners who rely on weekly withdrawals stand outside locked bank doors. For decades, their savings had existed quietly as numbers inside the banking system. And now those numbers were still visible, but no longer reachable. So people realize something unsettling. Just because your bank balance exists, it does not mean you can withdraw it. If the money is in the bank, why can you not take it out? And Greece would not be the last place this happened. Because moments like this reveal something unusual about modern money. The number in your bank account might not be money in the way most people imagine. Right now, somewhere in the world, millions of people are opening their banking apps. They see a number. Maybe $2,000, maybe $20,000, maybe far more. That number feels solid, reliable, real. It pays for groceries, it pays for rent, it pays for almost everything in modern life. But when that number changes, nothing physical actually moves. No vault opens, no truck transports cash, no bundles of currency move between banks. The number simply updates. Balances shift inside digital systems. And once you notice that, something strange becomes clear. Most money today does not exist as physical cash. But if that is true, what exactly is the number in your bank account? Inside every bank is a massive accounting system, a ledger. Every deposit, every withdrawal, every transfer, every payment, all recorded as numbers. When money moves, one balance goes down, another balance goes up. That's it. And as long as those numbers stay balanced, the system appears perfectly stable. Globally, more than 90% of money exists digitally. Physical bills and coins represent only a tiny fraction of the total money supply, which means most of the money people use every day is simply numbers stored inside banking systems. Numbers backed by trust. And most of the time, no one questions it, until something forces them to. And this is where the modern banking system becomes stranger than most people realize. Banks do not simply store money, they create much of it. When a bank approves a loan, something unusual happens. The bank does not take existing cash from a vault and hand it to the borrower. Instead, a new deposit appears. The borrower's account suddenly shows a balance that did not exist before. At the same time, the bank records a loan that must eventually be repaid. A new digital balance appears, and a new debt appears alongside it. Even central banks describe the system this way. The Bank of England once explained that most money in modern economies is created when commercial banks make loans, which means much of the money circulating today began as debt. But if banks create deposits this way, why does the system actually work? And this becomes clearer when you look at what actually happens when you pay for something. Imagine buying coffee. You tap your card. Payment approved. It feels instant. But behind the scenes, a series of digital updates begins. Your bank reduces your balance. The merchant's bank increases theirs. Payment processors record the transaction. Settlement systems adjust accounts between financial institutions. Central bank reserves eventually finalize the transfer. But to the person paying for coffee, It simply looks like numbers appearing and disappearing. Balances shift across a massive global network of financial ledgers. And as long as those ledgers keep updating correctly, everything feels stable. But that stability depends on a fragile condition most people never think about: trust. Most days, that trust is invisible. Cards swipe. Transfers arrive. Balances update instantly. The system works quietly in the background of everyday life. But when confidence disappears, the effects can spread quickly. Historians have a name for this moment: a bank run. In the early 1930s, during the Great Depression, several American banks collapsed this way. Rumors could spread through entire towns overnight. A neighbor might mention that a local bank was struggling. By morning, people were already lining up outside the doors. Some arrived before sunrise, hoping to withdraw their savings before the vaults ran dry. Inside the banks, clerks counted out stacks of cash. Outside, lines stretched down the street. Every withdrawal made the situation worse. The more people demanded their money, the faster the bank ran out. Some depositors succeeded. Many arrived too late. Once withdrawals began accelerating, the system could no longer keep up. Because the structure underneath modern banking was never designed for this. Most of the time, this fragility remains invisible. Digital balances update instantly. Transfers move across continents in seconds. Entire economies function on these numbers without anyone questioning them. But underneath that convenience is a quiet assumption that not everyone will demand their money at the same time. And when that assumption fails, the invisible structure behind modern money suddenly becomes visible, because the system works perfectly until too many people try to turn digital balances into cash at the same time.